Doom and gloom. 2021. The crash is coming. Hey, it's Kevin A. Malsh, Pine Financial. We work together so you succeed. Hey, you found us here on Facebook. You found us here on YouTube. Please hit like, hit subscribe. We'd love to build a good channel with a lot of subscribers so we can add more benefit to the community. Got an awesome guest with me today, Travis Spear. You know him, you love him. We're talking today about the market, COVID-19. We're going to stay consistent with this theme here until we're through this. Travis, I hear a lot of people tell me doom and gloom. 2021, the crash is coming. 60 seconds, tell us who you are and how do you react to that?
Sure. So Travis Spear, Pine Financial Group. I've been working with Kevin for going on 11 years now, originating hard money loans. In my personal life, also a real estate investor on a handful of rental properties. I've done some new construction projects and always actively looking for deals. Talk about forbearance 2021. How does this all shake out? And different people are thinking different things right now, but I just am not seeing anything to indicate that we're going to have this huge meltdown. We can get in a little bit of the details on forbearance, but just a quick note that I read yesterday was that the mortgage loan applications nationwide for purchases is up like 17 or 18% year over year. So last year, which was a pretty hot market and in most places, more buyers are out there looking today, even in the midst of the pandemic going on.
Yeah, it's interesting. And people tell me the crash is coming. And I've heard all different kinds of dates. And frankly, I've talked a lot about this. You and I think, are in agreement here. Housing is fairly strong, and it comes down to the fundamentals, supply and demand. And it feels like as we work our way through this pandemic, there's not a lot of impact in housing. But if we wanted to paint the picture for the viewers, it could happen because of the forbearance. So you briefly mentioned that. Why don't you tell the viewers exactly what a forbearance is, and then we could discuss how that could impact us in 2021.
Sure. The term forbearance is definitely being thrown around a lot right now. So to understand exactly what that means is important. So forbearance would be if somebody's maybe getting into a little bit of trouble financially as a part of the COVID-19, they would request to their mortgage servicer that they could go into forbearance. Well, forbearance is a period of time where you're not making payments on your loan. Now, when this first came out, there was a little kind of shaky about whether you should take the forbearance if you were in trouble, because there were some details that said, well, if you didn't make payments within 6 months, you wouldn't be able to refinance your loan or get a new loan. And so all of a sudden people would have been in a really tough spot, because on day one, it was 6 months, no payments, make it up on 6 months and day one. And then, if you didn't have the money to do that, then you could be in trouble. So then maybe you sell your house, but then you couldn't go get a new mortgage because you didn't make your payments for the last 6 months. In the last couple of months, a lot of that has loosened up and become a lot more attractive to the borrower. So now you can get your 6-month forbearance. And as Kevin informed me yesterday, at the end of the 6 months, if you're still not in a good place, you can automatically go to an extension of another 6 months. So you could potentially go a full year without making a mortgage payment. So good, bad. I mean, if you were really tight, that could help somebody out, right? So what happens at the end of the 12 months? This is also a part of what's changed, and probably some more detail will come as it kind of shakes out. But we're hearing that those payments would be more or less tacked onto the back of the loan, or maybe spread out over the remainder of the loan, depending on amortization and that type of stuff. But the underlying note is that your payments would likely be unchanged, or very little change. It's not going to double or go up by 50% and handcuff somebody who's coming out of a tough financial time. As you brought it to me yesterday, Kevin, when we were talking about this, the interesting thing will be the escrows, taxes, and insurance. Especially if you're in a high tax state. We do a lot of business in Minnesota and relatively high property taxes compared to what we see in Colorado. So if you've got a $5,000, $6,000 tax bill, and you haven't been paying in those escrows, that might bite you, unless some of those local governments then also help somehow to alleviate some of that. And then the same would be true for insurance, although typically not as expensive as taxes. Important to note that you might need to be able to come up with that insurance money, which is typically handled through your escrow.
Yeah, so I guess we don't want to get into too much detail. Travis, you did a fantastic job of explaining what that is. We have shot other videos of forbearance, what it is, and the risks to you as a real estate investor for taking advantage of that. So be sure to check out that video. But the idea of the crash coming in 2021, as Travis said, is because the forbearance agreement expires then. And with all these forbearance agreements expiring, that could create some defaults. So we're talking maybe April, May-ish of 2021 is when the majority of these are going to expire. We just talked right before I hit record on this video, Travis, you mentioned to me that there's between 8 and 9% of all loans are in forbearance. I think we're down to 4.7 million, and that's approved for forbearance. Not everybody that's approved has actually taken advantage and stopped making their payments, because there is a downside to that. So it's significant, but with the payment options, I'm not sure if it's going to be a big crash to the market. What are some things that could cause that crash, though, Travis?
Yeah, well, so in talking through, let's say that you just purchased a house with a FHA mortgage, and you put 3.5% down, and as a part of COVID, you lost your job and you're in a bad place, and after 12 months, you couldn't get back on your feet. You weren't making payments, so your loan amount has continued to go up. And a year later, the real estate market remains okay, but it's not going up by 12% a year. All of a sudden, you don't have the ability to make a payment, and you don't have any equity, so you can't sell your house. So now you're looking at a low or no equity situation for a typical homeowner. Would they have the ability to potentially move out and rent it? Maybe, but they're pretty tight already, right? So that's probably kind of the worst case scenario. And I'm unclear on how many of those we'll actually see. Most mortgages, kind of as an average across the United States, have some amount of equity. So if they got in too tight of a spot after 1 year, weren't able to get back into a place where they could maybe refinance or start paying again, they could sell the property and then exit with some money. Maybe at that time they could either downsize, or maybe they go rent a property or something like that. So I don't know that there's going to be, as an example, in our Denver market, we increased inventory to basically 1.93 months or something as of this week. So less than 2 months of inventory. I think that most people in our space, and this isn't to take advantage of somebody who lost their house, but would welcome more inventory in our market, especially in those price points. So I just don't see a real crash coming, because of the amount of equity that most borrowers have. But on top of that, the low number of houses relatively compared to the inventory there is today that would come on the market as a result of this. And then also remember that at the end of the forbearance, assuming nothing else comes out from the government to keep people in their houses, stimulus or whatever there might be, the eviction process is going to be, for an owner-occupied house, probably another 6 or more months. In Colorado, a place like Minnesota, it's going to be 12 months. So even if that inventory, if those houses do go into default, that inventory is not going to really shake out for probably another 9 to 15 months, depending on the state and the local foreclosure laws.
So even if we have a wave of defaults, wave of foreclosures, we're still looking at 18 months or so before you start seeing any of that hit the market. I think you and I agree on that. Is there anything else you could think of? Any other picture you could paint that would create a disaster that so many people are talking about?
I can't picture something that's going to make this real estate market drop off based on the demand. Earlier, you talked about supply and demand. And when we just look at supply and demand, there's not enough supply. And what's likely going to happen through this is less supply, we've already seen less building permits pulled. We're already seeing less listings that people may not, they may think, oh gosh, I'm okay right here. I'm not actually going to move up, or we're not going to make a move right now. We're going to wait a little bit. So just purely from a supply and demand scenario, I just can't see a situation where the market's just going to absolutely drop off. Also, keep in mind that interest rates are super low right now, not only historically, but relatively, right, for what we've seen in the last few years. And based on the amount of economic activity that comes out of housing, I just don't see the government allowing those rates to get to a point, with the quantitative easing, which I know you mentioned in some other videos. I was just reading an article this morning that talked about how the Fed would likely step in and try to even control the yield curves. So in order to keep things moving in the right direction, and a part of that is going to be keeping interest rates low so that people are continuing to buy and sell houses. It just creates so much money in our economy.
Yeah, look, we don't want to be ignorant to this. You and I agree on that, Travis. In fact, everybody at Pine Financial agrees. We're watching this closely. We're all in agreement. COVID isn't going to create the housing crash, but there could be some legislature or something like that could create some risk. But those are stuff that we can't really see coming. There is some in Colorado right now that we're keeping an eye on. But even if that passes, that still looks like that's going to be a little bit later in the future. So we'll shoot more videos about that if that becomes more of a threat. But everything that we're seeing, guys, the market's still strong. If you're coming across good transactions, I would not be pushing pause right now. I'd say definitely buy. Is there anything else you want to share before we close this out?
No, I'll just agree with that sentiment. I mean, there's, of course, a good opportunity if you've been a seasoned investor to look at your portfolio, maybe to be running a little smoother in your own business and having the opportunity to take care of or to jump on opportunities, whether that's using somebody like us to come in and finance your deals, even if you've been using a different type of financing before. We're definitely seeing some requests from borrowers that we're working with, maybe more nationwide type lenders who have shut down due to COVID and not lending and left people kind of, they're holding the bag. So we've had the opportunity to fund some of that stuff. I just, we'd love the opportunity to look at anything you're working on and see if we can be an asset to your team.
Yeah, we're hard money lenders. We're financing some commercial bridge stuff, fix and flips for sure, fix and holds. You could find out more, pinefinancialgroup.com.